Hi guys, in this video we are going to talk about what a spot contract is and look at a payoff and a P&L diagram for that. The main goal with these videos that I'm going to hopefully put out are getting you from the level of knowing nothing about stocks, forwards, options, up to the point of being familiar with the Black-Scholes formula and what it is, how it works, as well as other things like that in terms of pricing financial instruments. But to start, we need to understand what a spot contract is, what a forward contract is, and what are options. So those will be the beginning videos. Um, so to start, let's talk about a spot contract. A spot contract means you buy or sell an asset uh, at time zero. And when I say time zero, start to think in your head about being able to sell things on a timeline, right? So let's say I have a stock price that I'm going to call S here, and I have time on an axis. So here's time zero. Time zero is when? This is now, right? And time moves in this direction, and you could think of this as being 3 months. You could think of this as being 1 year. You could this is being 10 years, whatever. In finance, you have contracts where you can buy or sell things at certain points in time. And if you sell it at time zero, it's called a spot contract. So this spot refers to T0, right? Time zero. Other contracts like forwards and options, they refer to things that you can buy or sell starting at, right after time zero, all the way out to like 50 years, wherever. If you do OTC stuff, you can sell probably longer than that. But a spot contract is all about time zero. You are buying and selling something at time zero. And let's get some more terminology out of the way. Um, when I say buy, I'm going to refer to this sometimes as long. And when I say sell, I'm going to refer to this as short. So these are terms you definitely need to know. When you hear long, think buy. When you hear short, think sell. If you stick to that, you'll be in good shape. So now we know that a spot contract allows us to buy or sell or go long or short uh, at time zero. So I'll just put spot equals buy or sell, meaning go long or short. I'm going to put at T0. I'll put little t because that'll come into play too. So when we get into these mathematics, you're going to have indexes. One of these indexes is going to be a time index. So remember what I said before. You have in finance, you have a time. Time is going to come into play a lot. So you're going to have to index things using subscripts like um, little t0. That means time zero. And we'll get into that later. But what you need to know now is that a spot contract means you can buy or sell something or go long or short, equivalent. Buy means long, sell means short, at time zero. And you can see here on this graph that there's a time, there's a time dimension, and you're at time zero, and that's a spot contract. You're going long or short. So let's do a real sort of world example here, and then get into these payoff diagrams and things like this. So let's go to Google Finance. This is a website. You could go to google.com/finance, and you could put in the search bar GOOG. It'll bring up the price and the chart for Google, and you could see the price right now is $639.98. So what we said before a spot contract was a contract where you can buy or sell something at time zero. Time zero is now. Let's say that you're on your computer at Ameritrade.com, and Google is trading. The price is $639, and you want to buy it. So let's look at a payoff diagram for going long. Now remember, I'm going to start referring to long and short here. So let's look at a diagram where I have payoff on the y-axis and I have the stock price. I'm going to call it S. This is the stock price on the x-axis, and down here I have 0, so the stock price cannot go below 0, so that's a bound to this diagram on the x-axis. Now let's think about what the payoff is of owning Google stock at $639.50, right? Something like that, or 98 cents. So Google is trading for $639.98. When I say payoff, this means do not take into account how much it's going to cost to buy this stock. So if we don't take into account the cost, right, then the payoff is just going to start at 0, and for every increase in the stock price by $1, we would get a payoff of $1, right? So if the stock price was $1, we would get a payoff of $1 because we're not concerned with how much it costs. We don't have to account for that. So this is assuming you could go to a stock exchange and say, "Hi, sir," or "Ma'am, give me Google stock," and they give you $639.98 of Google stock. In that case, here's the stock price, $639.98. Your payoff would be $639.98. Remember, payoff, you are not accounting for the cost of this contract. It's assuming no cost. So in that case, your payoff is just going to be a straight line because it's a 45-degree line, just a one-to-one mapping of stock price to payoff. Okay, so this is your payoff. That should be a straight line. And that's simple, right? The main point is that when I say payoff, it means do not include the cost of the contract, the cost or gain, right? So this line here is the payoff of going long 1 GOOG, Google stock, at 639.98. This is what the payoff looks like. And remember what I said before, it doesn't include the cost of the contract, what you had to pay for it. The other diagram we're going to do in a second will include the cost. But why am I doing this? Let me just say this right now. It's because in many books you're going to read or classes, some people are going to take that into consideration. They're going to take the cost of the contract into consideration. So you might see a graph that looks like this, or you might see the graph we're going to see in a couple minutes. But before we get there, we saw that the price of Google stock is $639.98, and we see that you can go long it. You can buy Google stock. You can also sell it. If you go to your broker on your online account, they'll allow you to sell Google stock. You have to fill out some more paperwork, but it's just additional paperwork. You can still sell it. So what does the payoff look like if you sell it? It's going to be the same 45-degree line, only in this direction, right? There's a one-to-one mapping here of stock price to payoff. So if the stock price is $639.98, then you get a payoff of negative $639.98. Now, how does that make any sense? Well, we're not taking into account if you sell it, you would actually gain that $639.98. it would be a positive up here. But we're not considering any gains or costs of trading these contracts, of purchasing these contracts or selling them. So I don't want to confuse you, but payoff just means don't worry about gaining anything. Like if you sold it, you would actually gain 639.98, or if you bought it, you would actually lose it. We're not considering that. We just want to do this to show you that if you don't include the cost, this is what your payoff would look like. And you'll see down the road why this is important. Now, I just want to write here, this is equivalent, this line is short 1 GOOG at 639.98. So this is kind of, so now we have a spot contract, right? And why is it spot? It's because it happens on the spot. There's no time delay. At T0, we go to a stock exchange and we go long a Google at long one Google share, or buy it at 639.98. We could alternatively sell or go short one Google stock at 639.98, and this is what our payoff would look like. And payoff, remember, means don't take into account the cost or the benefit of entering into these contracts. Now let's do the P&L diagram. So the P&L diagram is going to look very, very similar to this, only it's now going to account for the cost of these contracts. So let's see what that looks like. Actually, I'm wondering if I could do it here or if it'll get too messy. No, it'll get too messy. So let's do this. Different color. Let's do a P&L diagram now. So now we have on the y-axis P&L. And on the x-axis, we have, again, we have the stock price. And now we're going to make this, again, like what we saw before. It's bounded at 0. The stock price cannot go below 0. And we have our price here of $639.98. That is where we went long one Google stock, right? At this price, we went long. So now what is our payout? What is our P&L going to look like? Now when we take into account how much we paid for it, well, if we paid for it, that means our initial payoff, is going to be a negative 639.98. Well, actually, that means we paid $639.98. We paid this amount here. So we're not going to make any money unless Google goes above, meaning goes up here, right? So we need Google to go up here in this way, and then we make money. So this is profit. Everything over here is profit. If Google goes down, right? If Google goes down, then we're going to lose money. This is loss. So that is what our P&L diagram looks like for a spot contract going long. This is again long 1 GOOG at 639.98. So this is what the did I say payoff just now? I meant P&L. This is what the P&L diagram looks like of a long one Google at 639.98. Now let's look at the short Google at 639.98. Well, we saw before that the diagram started at 0 and it went down for the payoff. Now we can take into account what we get by going short. So when you go short something, when you sell something, someone's going to give you money, right? So someone, if we enter that contract, is going to give us, I shouldn't do this in green, let me do it in yellow. Someone is going to give us $639.98. So that's good. We put some money in our pocket. And we make money as long as Google stays below $638.98. So this line here is now profit. And why is this profit? Well, this is because, remember, this axis here is the share price, and moving in this direction, it's below 639.98. So this is profit. And if you sell Google, you want it to go to zero. So the maximum profit you're going to make is at zero here, right on this line. If Google goes bankrupt and you sell Google at $639.98, you're going to make $639.98. If Google goes down to $630, over here, if it goes down to 630, then you would go up here and you would map it over here, and you would make, $9.98. That's what you would make over here on this line, on this yellow line, right? Alternatively, if Google rises in price, if Google goes up in price, you're in trouble if you sell it. Because now, let's say Google goes up to $700. Yeah. Let's say it goes up to 700. Then you're down here, and you have a payoff of, well, this is kind of not really mapped on the right dimension here, because this is negative 639. So the dimensioning is off on these arrows, but actually I should make that 700. Let me just move it over real quick. If Google goes to 645, let's say, then you're going to get a payoff here on this yellow line, right? That's going to translate, or a P&L that's going to translate to $5.02 over here. And notice this is not drawn to scale at all, but you get the picture, right? When you go short something, you want the price to fall. So this axis here is the price. Going out here, it's increasing. The price is increasing. And down here, it's decreasing. You bought it at 639. If you sold it, you're going to make profit when the price falls. So here you see that. You make profit as the price falls. And you make the max profit at 639. If the price rises and you sold it, you're on this yellow line here, and you could lose a crazy amount of money if Google goes up to, $10,000 or $800. You're going to lose a lot of money. Alternatively, if you bought it at $639.98, you would gain money if the price went up. So here's your gaining money. As the price moves up, as S increases, your P&L increases, your profit goes up. You have an infinite amount of profit. And as the price goes below 639.98, you have a limited downside, but it's a big downside. You could lose all $639 down here if Google goes to zero. So this, I should write here, is again short 1 Google at 639.98. So what I wanted to do in this video was get you familiar with some things related to spot contracts and some terminology. So let's recap what we learned, right? First thing we learned is that in finance there's going to be a time dimension, and you need to understand um, that you can trade something right now, and that would be called a spot contract. Alternatively, you could trade it in a different time. You could trade it in the future, in 3 months, in a year, in 10 years, in 50 years, whatever. Those contracts are called either forwards or options or swaptions or all kinds of other things, but they're not called spot. Spot is at time zero. And we'll get into these other products in other videos. The other thing I wanted to tell you was that spot means you can buy or sell something at T0. And buy or sell means long, or buy means long and sell means short. You definitely need to know buy means long and sell means short. And then we looked at what a payoff is. A payoff, it doesn't account for the cost or the benefit of going long or short. It just says exclude the cost and benefit, and give me a diagram so I can imagine what this looks like from holding this contract. And here you see the payoff of going long when Google is just a 45-degree line. It's a one-to-one mapping of the stock price to the payoff on the y-axis. And if you go short, it's a 45-degree line in this direction here. Notice that stock price cannot go below zero. And then we looked at the P&L. So this graph's a little bit messier, but still think you should get the picture. The first line we drew was going long a Google stock, 139.98, and you see that if you go long at 639.98 and the price rises, then you make profit, potentially unlimited. If the price falls down here, you can lose all your money. If the stock goes to zero, if this stock price goes down to zero, then the P&L is going to be negative 639.98. That's for a long Google stock at 639.98. If you go short it, then your arrow sort of just flips and you make money, but it's limited money. You can only make 639.98, and you have unlimited risk. You have unlimited downside. And that's pretty much it for this video. I just wanted to show you that. In other videos, we're going to go over these contracts here. What are they? What are these forwards? What are these options? And what do they look like related to these payoff and P&L diagrams? And again, if you're asking why is this important, it definitely is important. If you're going to get a job in trading or related to that, related to working with these products, you're going to need to know what these things are. And then if you want to advance into how do you price these instruments, instead of just understanding what they are, how do you actually price them, you're definitely going to need to understand what these diagrams are and what these instruments are. So that's it for this video. In the future, I'll put up some more on these forwards and options and a bunch of other stuff. So thanks.